Welcome to episode 2 of this series, in which you'll learn how you can start trading stocks as a beginner. Before you watch the rest of this video, be sure to watch part 1 of the series. If you haven't yet, just click on the link in the caption. Okay, so before we proceed, let's recap the last video. We talked about setting clear goals, assessing your risk tolerance, educating yourself, reading books, paper trading, choosing a reliable brokerage. You've decided your investment goals, what kind of investor you are, which by the way entails knowing your risk tolerance and capacity for risk, and whether you'll be taking an active or passive approach to investing, determined how much you're willing to invest, and figured out how you want to invest in the stock market or in a company or wherever. The next step is choosing an investment account. Choosing an investment account. For the hands-on types who want to manage their own money, this usually means a brokerage account, while new investors who prefer a little help can open an account through a robo-advisor is a sensible option, both of which can be done with very little money. The DIY option, opening a brokerage account. An online brokerage account mostly offers you the quickest and least expensive path you can take to buy stocks and funds, and a variety of other investments. With a broker, you can open an individual retirement account, IRA, besides having a workplace plan. But if you're already saving adequately for retirement in an employer 401k or other plan, you can open a regular taxable brokerage account. Normally, you'll have lots of options for investing in stocks, which could include individual stocks, stock mutual funds, and exchange-traded funds, ETFs, and stock options. And it's always a good idea to evaluate brokers based on factors such as costs, investment selection, and investor research. And tools. While a brokerage account is generally taxable to the account owner, there are no contribution limits, no penalties for withdrawals, and greater flexibility than other investment and savings vehicles, such as retirement accounts. Also, brokerage accounts can be held by an individual, jointly with other individuals, and can even be opened for minors under the Uniform Gifts to Minors Act, UGMA, or Uniform Transfers to Minors Act, UTMA in the US. The passive option is opening a robo-advisor account, which offers the benefits of stock investing without requiring you, its owner, to do the legwork required to pick individual investments. A robo-advisor service works without the need for direct human contact and provides complete investment management. The typical service begins with the client completing an online survey with information that gauges risk tolerance and identifies investment goals, after which the robo-advisor automatically buys investments that are suitable for the client based upon the information collected, and also builds the client a portfolio designed to achieve those aims. And yes, you can even get an IRA at a robo-advisor. All this may sound expensive, but robo-advisor management fees in the US are generally a fraction of the cost of what a human investment manager usually charges. That's about 0.25 of the client's account balance. Just remember that if you opt for a robo-advisor or an online brokerage, you can get your account opened up in mere minutes and start investing. And if you go for a human financial advisor, you'll need to interview some candidates to find one who'll work best for your needs and keep you on track. Selecting your investment options. Once you've identified your risk tolerance and investment accounts are open, you're ready to select your investment options. Of course, figuring out what you want to invest in can be daunting for many beginners. But if you've opted for a robo-advisor or human advisor, it'll be a piece of cake. If you're using an advisor, either human or robo, you won't need to decide what to invest in because it's part of the value offered by these services. But if you're using a brokerage, you'll have to select every investment individually and make trading decisions. You can invest in individual stocks or stock funds, among many other assets. And the good news is that best brokers offer free research to help with this process and offer a ton of resources to aid beginners. So, like I said, you're good either way. And if you're managing your own portfolio, you can decide whether you want to invest actively or passively, with the key difference being that you get to determine how long you want to invest. Just so you know, passive investors generally take a long-term perspective, while active investors often trade more frequently. However, research shows that passive investors tend to do much better than active investors, so you might want to go that route if you're confident enough. Anyway, remember that it's generally a good idea to diversify risk, which means owning a combination of different asset types, which are primarily stocks, bonds, and cash. But again, only if you can afford it financially and practically. Funding your account. Once you're done with that, and before you place trades in your investment account, the transitional step is funding your account with cash. In the US, this is typically done through a simple form that you complete online, and it then connects your bank account with your brokerage for electronic funds transfer. Once connected, you can transfer single fixed amounts, or you can set up recurring amounts to transfer periodically, such as on a monthly basis. Of course, the key to building wealth is to add money to your account over time and let the power of compounding work its magic. What this entails is budgeting money for regular investments into your monthly or weekly plans. You're probably wondering how much you should invest. Well, that entirely depends on your budget and time frame. Most major online brokerages in the US these days either don't have an account minimum or the account minimums are extremely low, so you can get started with very little money. Plus, many brokers allow you to buy fractional shares of stocks and exchange-traded funds, ETFs. If you can't buy a full share, you can still buy a portion of one, so you can pretty much get started with virtually any amount. And it's just as easy with robo-advisors too. Some of them have an account minimum, so you'll simply have to deposit the money and the robo-advisor will handle everything else for you. You can even set up an auto deposit to your robo-advisor account. And the benefit is that with it, you'll only have to think about investing once a year at tax time. Convenient, right? While you could invest whatever you can comfortably afford, experts recommend that you leave your money invested for at least 3 years, and ideally 5 or more, so that you can ride out any bumps in the market. Alternatively, if you can't commit to keeping your money invested for at least 3 years without touching it, you should consider building an emergency fund first. What it does is it prevents you from having to get out of an investment early and allows you to ride out any fluctuations in the value of your stocks. Alright then, once you've opened your account and deposited money into it, the next step is literally to start investing and trading. But that's all for this video. I hope it's helped you understand the process of how you can start trading stocks. Let me know in the comments if you have any questions. In the next episode, we'll take a look at how beginner investors can manage their investments and build and automate their portfolios. So be sure to keep watching this channel. Bye for now.